All right. Now I'm going to test some things out real quick because I haven't done this setup before. So give me 1 second in terms of making sure that everything's working well on my end. I'm going to check my audio levels on my end. But if you're watching this, hey guys, this is the AP Macro Cram session where I am here way too early in the morning to start reviewing AP economics stuff with students. Give me 1 second. I'm going to check this video out on my end to see if the audio works fine. I brought my mic from home, but don't know if it reads super high. Koya, you're already here. Awesome. This video is restricted. Why would it be restricted? Tell me it's blocked on the school Wi-Fi. That would be so funny. Oh my God, I'd lose my mind if it was blocked on the school Wi-Fi. I can do it. I'm not sure why I can't. I wouldn't be able to. Here, let's do that. See if I make it 4 kids, the school might let it clear through. All right. Change some settings, and then let's see if I can get the audio pulled up on my end. Koya, is the audio okay? Is the volume all right? Or is it too quiet? I'm going to need user feedback for a little bit of this. No, it still doesn't want me to watch it regardless. Interesting. Let's try with my other account. Testing. No, okay, the audio sounds good on my end. Sweet. Okay. I could turn off my headphones then and I can tell what's going on. All right. Well, good morning, everybody. I am coming to you from an undisclosed location in the high school that I teach at. They gave me a random room that no one is presently using in a new part of the building where I have a computer screen or a TV screen and there's no way for me to set it up or hook it up. So that's super great. But I've got a whiteboard and I brought all my expo markers and I have about 4 different computer things that I brought from home that are all here, including a better webcam and my mic and all that stuff. So in this review session or in this cram session, sorry, I've got 2 computers right here. So if you're seeing me look left a lot, that's because my work email is on the left and I need to make sure I'm still kind of doing my job because I'm here today at work. So no, nothing big. Nothing scary on the emails. But I'll be doing primarily what you guys request. I've made videos over everything at this point, and I did the Super Saturday a couple days ago where I went through every single graph in a decent amount of detail. I would say I hit about 80 to 90% of the stuff for each graph in that, as well as basically every other major repeated FRQ topic that I see a lot. So I hit all of the major stuff in that video. This is more of like, okay, it's the morning of the exam. There we go, I moved the video over here. It's the morning of the exam. What do you need? Do you need math practice? Do you need graph practice? Do you just need me to sort of like fling questions out into the ether and see if you can hear anything? Well, the AC is loud in this room. It's good to know. Okay, so we'll get started here in a couple of minutes. I started this thing a little bit early just to get the audio, make sure that that's working right, and to make sure that everything on my end looks good. You need some formulas, Koya. Okay. There's a bunch. You can always look up an AP Macro Formula sheet if you want. I've got one on my Moodle. The ones that you need will be the multiplier-based formulas, because I can guarantee they're going to make you do multiplier stuff at various parts of the test. Probably 3 or 4 questions that'll involve multiplier math, I would bet. If not an FRQ that'll involve it, maybe an FRQ that'll involve it. So I'll put those on the board first. Let's get the multipliers out of the way, so I'm confident those will exist. There's really just 3 different multipliers. Oh boy, I don't know if you can see that. Can you only read that backwards, or is that flipped properly for you guys on your end? I really hope it does. Otherwise, I have to write backwards, and that's not a thing I can do. Okay. What the multiplier formulas are: the spending multiplier, the tax multiplier, and the money multiplier. These are our 3 multipliers. The spending multiplier is 1 over MPS. The tax multiplier is negative MPC over MPS, and the money multiplier is 1 over the reserve requirement. It's blurry when you're at the board. Oh, because it loses focus. The camera's focusing on me automatically. So I'm gonna stand closer to the board. Is that doing it better? Yeah, it's a little bit better. I'll also move my screen up a little bit. There we go. That seems a little bit better. Yeah, that's a little bit better. Sorry, I'm just setting everything up for the first time with an actual whiteboard, and I'm not used to that. I have the little baby whiteboard. So these are our three main multipliers when we're doing AP Macro. The spending multiplier is referring to whenever you do a change in spending, it ends up having a much larger impact on GDP. Because I should probably turn off focusing on this camera, but I don't know how to do that from YouTube, whatever. Whenever you're doing a change in spending, it has a much larger increase in GDP, because whenever you spend money, like that money goes to somebody else, then they spend it too, and then it goes to somebody else, and then they spend it too. So if we do like a $2 billion stimulus bill, it's going to do more to GDP than just $2 billion. It's going to hit by a lot more than that. And the way you figure out how much it's going to hit by, or how much it could hit by, it's like the formula that we use for the spending multiplier is you take an initial change in spending. Yeah, you can see it. The TV's going to get in the way here in a second. Times the spending multiplier gets you the change in GDP, aggregate demand, or income. So that's that. You take an initial change in spending, basically just the $2 billion that I'm giving you as an example. You multiply by 1 over the MPS. That'll have to be given to you, or they have to give you information to figure it out. The MPS is for every dollar you earn, how much of it do you save? So if they give you information like, hey, Billy makes $10 more than he did last year and is saving away $250. Find the multiplier. It'd be 1 over 0.25 because he's saving 25%. So 1 over 0.25, and then 1 over 0.25 would be 4. It's the right way? Perfect. I was making sure. So I would just multiply whatever my initial change in spending is. If it's a $2 billion spending change and the multiplier is 4, that just means my GDP would change by a maximum of 8. And that's an important thing with all of these multipliers. Whenever you're using a multiplier, the number that it's going to spit out to you at the end, like the change in GDP deal, is always like, say, best case scenario, although it could be worst case scenario depending on if it's going up or down, where GDP could change by as much as 8 billion based off the multiplier stuff. It might not. The main reason why it wouldn't would be, like, we say that for every dollar you spend, or every dollar you make, you spend this much. That's not consistent person to person. Not every single person saves and spends the same amount. So if we said the government did this $2 billion thing and people just happened to not spend all that they were going to, the multiplier wouldn't be as big. The effect wouldn't be as large. So if people saved any more than they normally would or anything like that, that would knock it down a peg. It would limit how effective it is. For the other two, the tax multiplier formula, I'm going to give some space down here, is basically the same as this one. It was almost identical to this one, my initial one in blue. It's just a change in taxes times the tax multiplier equals the change in GDP, aggregate demand or income. It's not anything different. It's the same like logic. You take initial change in a thing, you multiply by the multiplier for that thing, and it gets you the final change in usually GDP or some much larger measure. Now, the tax multiplier, it's important to mention here, is negative because it's very important to keep track of it in these questions. Are they saying that they're raising or lowering taxes? Because like if they raise taxes, then my GDP change should be negative, right? Because if taxes go up, spending levels don't go up, they go down. That's why the tax multiplier is negative. It's because in this formula, if I had positive change in taxes, like an increase in taxes, my final answer based off logic should be negative. So that means my multiplier would have to have been negative. Now, if it's taxes being lowered, that means my change in taxes is negative because they like decrease taxes by 500. So it'd be like negative 500 times negative something else gets me a positive answer. Let me grab my tea real quickly. I've been up since 5:30 this morning trying to get all this stuff set up because I'm the only person in the building who does a live stream for this. So kind of just going rogue and figuring all of it out. Okay. I will say this room is kind of nice. There's a bunch of like really cool chairs and desks in here. And they've got a TV screen and they don't even use this room. What the hell? All right. Give me this room. There's no windows though, so that's kind of a bummer. All right. Oh, and the money multiplier. Sorry, I'm spacing out a lot. It's still kind of early in the morning for me. Apologies. That's why this is why I did the Super Saturday stuff at 10 a.m. because I was more awake then. So the money multiplier that we use is it's a little different here, and this mostly has to do with banks and will be a definite thing they ask about when you if you ever have to do a bank balance sheet problem, which there ought to be at least one of those in the multiple choice, probably like a two-part multiple choice question where it's like, refer to this bank balance sheet for these next couple of multiple choice questions. And they're like, here's a bank balance sheet, here's a couple questions. Like that, I would bet on. And then there may even also be an FRQ. Like I said in class that I think that bank balance sheet is a pretty likely FRQ topic for this year because I didn't see any of them last year. And I didn't see any of them for the last like 3 years. And they're on a pretty good, like every 4 years, you'll see this stuff start to repeat. So for these, you take the change in the excess reserves. You multiply by the money multiplier, because the nice thing is, with all of them, they're called multipliers because you multiply. And it gets you a different thing. This is different, that's why I'm using red. It gets you the change in the money supply. It gets you a change in the money supply. Basically, the way this one works, at least from a logic standpoint, is very different. It's an entirely different thing. It's that whenever you give your money to a bank, banks can loan that money out, which are like, yes, McRitchie, I know this. That's how banks make money. I'm like, good. But did you realize that whenever you take out a loan, most people, most of the time, take that loan money and put it in their bank account until they need to use it? Like, you're going to go buy a car, you get 15 grand in loans because you know that's about what you need to get for your car, and then you go car shopping, or you've gone car shopping, but there's a bit of a delay in between you getting the loan and you buying the car. So in the meantime, you're not carrying around 15 grand. You put it in your bank. The bank reads that as a deposit. That 15K of loans you borrowed for your car has been deposited into the bank, and the bank can loan out a chunk of that. Effectively, what they've done is they've turned one loan into more than one loan based on if you deposit it, effectively creating money. They're making money exist in the economy, spendable money you can spend on your car, and the next person who borrows can spend on whatever they want to, all down the line. They're making money that exists in the economy that like was never printed, doesn't physically exist anywhere, does exist digitally and conceptually. So that's why it says change the money supply, because banks can actually change the money supply by lending out excess reserves repeatedly on top of itself. It's crazy stuff. But they make money exist that didn't otherwise exist. It's wild. It's why the Federal Reserve, even though it does print money continuously, doesn't need to print as much as you would think, because banks already make money exist that already doesn't exist. And I think at this point we're at, if not close to the point where we have more digital money than physical, meaning we don't actually have physical currency to back up all the money in your bank accounts and stuff like that, which is crazy, but it's fine as long as we can still keep using technology and stuff. Again, if Terminator happens, we're all doomed. But that was already the case because the robot uprising is inevitable. Remember, in the long run, we're all dead. Okay, what do we got next? That's the math I'll guarantee you have to do. I would be shocked if there wasn't multiplier stuff, like 3 or 4 questions worth of multiplier stuff in your test. Maybe even it'll be on the FRQs. If they do a balance sheet, they'll use that for sure. If they do an aggregate demand supply question, they can always sprinkle in spending and tax multipliers as just a way to mess with you. There is more math than this. A lot of it is Unit 2's math. That is the know the formulas for real GDP using the GDP deflator, the formula for GDP deflator, the formula for CPI, unemployment rate, and labor force participation rate. Those are the 5 big ones for Unit 2. You should also know GDP is like CIGXN deal. That part you should have been aware of for a while. But the big 5 for Unit 2 are real GDP using the deflator, GDP deflator, CPI, unemployment, labor force. And I'll just run through those because no one has asked any other questions, so Koya gets first dibs. Those of you guys that are watching in the chat, thank you for watching. If you've got a thing you want me to go over, type a question about it in the chat. I can see the chat, I'll respond. Corey just asked for some math. So let's do Unit 2, the 5 big ones. Or what I would call the big 5. Because again, these are ones that could be used fairly frequently. Sorry that it goes blurry whenever I step to the board. My face isn't on the screen. The camera is trying to focus, and if my face is invisible, it freaks out. So it's going to lose focus every time I turn my back. I apologize for that. Okay, Unit 2's big 5. Real GDP equals nominal divided by the deflator times 100. Now, if they don't explicitly tell you what nominal is, there's a couple of ways to figure it out. One, nominal GDP is just your regular GDP. So if they give you like CIGXN, that would be your nominal. You can also do price times quantity if they give you like prices and quantities of goods. Just remember that nominal GDP is the total dollar value of everything produced in your country in a year. And you should be able to figure it out even if they don't give you stuff that you see familiar with the formula. If you know what the thing is, it's really easy to figure it out. Gdp Deflator is the one like exception to that because there is no way to just like magically get it. You have to have variables to figure it out. The Gdp Deflator is nominal over real. Times 100. So those two formulas are kind of the same, if that makes you feel any better. It's real equals nominal over deflator. Deflator equals nominal over real. So nominal's on the top half for both. The other thing is on the bottom half. That's a relatively easy thing to remember. As long as you don't forget to multiply by 100, please don't forget to do that. That gets people into some weird trouble on FRQs. And when you're doing an FRQ with this, it should be kind of obvious to you if you botch it, because your deflator should always be a number like around 100. Like a normal deflator is like 100. That's your deflator in your base year is always going to be 100 deal. So like a deflator of like 106 is fine. A deflator of 1.06 is terrifying, because what that means conceptually is that since the base year, prices have gone down by 99%. No, probably not that. So if you're getting some numbers like 1 point something or 0.0 something for deflator, you forgot to times by 100. Don't forget to times by 100. Your real should look similar to your nominal GDP a lot of the time. Like having a nominal GDP of 2,000 and a real GDP of 1,800. Like, yeah, that's close. We're in the same like ballpark. You shouldn't be multiple decimal places off. If you are, you probably forgot to do a times 100. Those are number 1 and number 2 of the big 5. CPI. This is a shot in the dark kind of thing. They don't ask you to do the math for CPI all the time, but whenever they do ask it, students immediately fail and just do terrible on it. I did a problem with CPI's math on the Super Saturday. That was a great example of it because it just murdered kids. But the formula is you take the price of a market basket in the current year over the price of a market basket in the base year, and you multiply by 100. So for this one, they either have to straight up just give you these, or at the very least tell you how to find the market basket. Like in the example I used on Saturday's stream, it was they had like a chart of prices and quantities and said that taking 10 of this good and 5 of this good is your market basket. So I just had to find the price of 10 of that good and 5 of that good in those 2 years, divide them, and multiply by 100. There is no calculator allowed on the in-person physical exam, but almost every time they do this, the way you find the answer actually wouldn't need you to do a calculator. Like the one on Saturday, this number ended up being 100. So times 100 divided by 100 canceled. It was just the first one, which was like 110 or something. Because when you see 110 up here, you're like, oh, sweet God, what can I divide 110 by? And when you figure out that it's 100, you're like, that I could do. So that's 3 of the big 5 for Unit 2. The other 2, I'm about to erase this. So if you need to write them down, you can pause, write them down, whatever. I'm about to erase these. I need a little bit more space for the last 2. Unemployment rate. And labor force participation rate. Unemployment rate, number of unemployed divided by the number in the labor force times 100. Number of unemployed divided by number in the labor force. Important to mention here, the labor force is all of the employed and unemployed people. So if they don't tell you who's in the labor force or what the labor force is as a whole number, but they tell you how many people are employed and how many people are unemployed, add them. That's your labor force. Labor force is just employed plus unemployed. The number of employed divided by number in labor force. Remember, the labor force is everybody who is trying to work, whether they are successful and actually are employed or not successful and are unemployed. But if you're trying to work, you're in the labor force. If you give up on working or give up on trying to find a job, you are not in the labor force and you are not unemployed. It's important to mention. You're only unemployed if you're without work and attempting to find work. That's the big deal. The other one is labor force participation rate. Put LF, participation rate, but it's labor force. This one isn't as important as the other ones I've shown for this big 5. It's just a thing that students, again, like freeze up on tests a lot of the time. They're like, wait, how do I figure that out? You take the number that's in the labor force. Someone's going to say number of employed and unemployed. Number of employed, which comes to ENP, and unemployed, divided by the working age population, again, times 100. All of the big 5 formulas for Unit 2 have times 100 at the end. Now that one number is just telling me out of everybody who conceivably could be working, how many of them are actually trying to. Like the total working age population is everybody who like theoretically could work. And the number of employed and unemployed people are the people that are trying to work. This number is usually for a country like between half and 3/4. It's a pretty normal range. For us, we're like a little over half when it comes to our labor force participation rate, which is bad. Like it's bad to see that number because what that means is that of everybody who theoretically could be working, only half of them are even trying to work. Now, that'll include like stay-at-home moms, which like fine. Or stay-at-home dad, which also fine. Like if they're not trying to, that's not a problem. But it'll also include people who've given up. And there's a lot of people who gave up looking for jobs in the pandemic here. Because like they don't want to work retail because they don't want to risk their immune system stuff. And they don't want to work minimum wage because it's pretty low, especially if you live in like states like Texas where it's been $7.25 for a while. But yeah, you might not want to work because unemployment benefits have been pretty good in the pandemic. So being unemployed pays better. Not to be unemployed, they do have to be trying to look for a job. That's always the caveat. Okay. I think I have answered Corey's question as best as I can in a reasonable amount of time. That's all the math I would guarantee. I would say that one questionable that you would see labor force participation rate, but all the other formulas I ran through here are all ones that I would be like, yeah, you're going to see these. I would be surprised if you didn't. The other formulas that I've given throughout the year are like GDP growth rate stuff. Oh, yeah, there's one more. The Fisher equation, probably. You'll probably see the Fisher equation and the quantity theory of money equation. So these are Unit 5s. Unit 2 is big 5, and Unit 5 is big 2. Oh, that's good. Unit 2 is big 5, Unit 5 is big 2. So for Unit 5, there's 2 formulas that matter for Unit 5 that I think these are pretty likely to be on your exam. That would be, oh my God, I spaced. Oh, the Fisher equation, which is, you might see this written a bunch of different ways. This is how I like to write it. Real rate, real like blank rate equals nominal blank rate minus inflation rate. The reason why I say the blank there is that that's true for any real and nominal rate. The Fisher equation is about interest rates, so it's like real interest rate equals nominal interest rate minus inflation rate. You might also see it as nominal equals real plus inflation. That's the same thing because of algebra. I like to write it like this. I prefer the subtraction problem logic of it because I like to think of it as the difference between real and nominal is inflation, and in second grade math, difference meant to subtract. So nominal minus inflation gets you the real rate. Again, this works with any real and nominal rate. They could throw real weird curveballs like the real income growth rate was 4% and there was 2% inflation. What was the nominal income growth rate? It's like, it doesn't matter what words they put there. If it's a real rate and a nominal rate, you just take the inflation rate out of the nominal and you're good. With any real and nominal rate. We can use that for GDP growth rate. We can use that for interest rates. We can use that, again, for any real and nominal percentages. It has to be all percentages. It's all rate. So it's always percentages, but you can use it. Now, if they're giving you like a normal math problem and they're not like giving away the percentages on it, don't try and find the percentages to then do this formula. This formula is meant to be done when they give you these variables. You can use it the other way, you just might not get the same answers because the questions aren't always crafted with that logic in mind. So if they gave you numbers to find real GDP in multiple years and you found the real GDP and then you just found the growth rate off of that to try and figure this out, it's a bit too much math for a multiple choice question for you to do. If you did it on an FRQ, it would be fine. It would just get you a different answer probably, but it'd be fine. On a multiple choice question, if they tell you the nominal and the real or the inflation rate, they give you two of these three variables, use this formula. Use it every time. It saves you so much time. That's called the Fisher equation. And then the other one for Unit 5 is the quantity theory of money equation. M times V equals P times Y. M times V equals P times Y, where M is the money supply, V is the velocity of money, P is price level, Y is real GDP. Basically, if you take the money supply and multiply it by how fast people spend it, which is the velocity of money, that'll get you price level times real GDP. Price level times real GDP as an important caveat, which is it's basically as important as knowing the formula is knowing this, that P times Y equals the nominal GDP. Because if you take price level, the average price of everything, and you multiply it by real GDP, you have effectively undone the fact that real GDP took out inflation, right? Because real GDP takes it out, you've just thrown it back in there. So that's how you get the nominal GDP. So if you increase the money supply or the velocity of money, you're going to increase nominal GDP, which shouldn't be crazy because like if you spend money faster, GDP would go up because it's in a set period of time. If you have more money flowing in your economy, based on what we know about aggregate demand, that should lead to more GDP. So that shouldn't be crazy. It's just a formula to back up some logic and grab stuff. I've got an email. If you've got a question, please feel free to type it in the chat. I have finished with the math that I would like to cover now. If I can do more, I guess, but that's the big like formulas that I would bet are on the test. Someone joined an AP macro tutorial meeting this morning. That's cool. They shouldn't have done that. So that's wrong. That's a bad idea. Okay. Someone joined a Zoom meeting that I'm not hosting right now. They think I might be doing it over Zoom. That's not how I do things, but okay. They'll figure it out. So what do you want me to go over next? Anything is fine. Even things from Saturday are fine. I don't care. It's your exam. It's your review. What do you want? I can pick stuff, but I'd prefer you guys ask me what you need. It's a bit of a delay between me asking you a question and you guys being able to chat responses, so it's always fun. I can't refresh it. That would mess up the stream, I bet. Let me check it on this end. I should mute my phone. It's a good idea. Oh, some of you guys can't comment on the live stream. That is super weird. I don't know why you can't. Classic school Wi-Fi garbage? I'm not sure. But I just got someone asking if I can do comparative or absolute advantage. Yeah, so email me if you can't type in the chat. Just email me your question. Emma, that worked. Thank you. So yeah, comparative and absolute advantage, for sure I can talk about that. Let me turn my speakers down. Actually, does that still pick up my audio? I'm going to keep my audio unmuted, actually, just in case. Okay. So I got a request for comparative and absolute advantage. Big thing to know. Make sure you know the definitions of these. It will make your life so much easier. If you forget how to do the math, the definitions should help you figure out the math. Absolute advantage is, and you can write it, who can make the most given the same amount of resources. If I give them an even playing field, who is producing more of the thing? That's who has the absolute advantage. Just who can make more given the same. Comparative is who can produce at a lower opportunity cost. So the two things we're looking at here. So let's go with an example. I need people. Let's go with Tony and Brandon. Just picking names off the top of my head here. Let's say they can make two goods. Let's go with those two goods are desks and chairs, because I'm in a mostly empty room. Moen, I just got your email as well, so I'll get to your question next. Desks and chairs. Tony can make 20 desks or 10 chairs. Brandon can make 30 desks or 10 chairs. People with 10 for both. So I got 20, 30, 10, and 10. I can tell absolute advantage immediately. Absolute advantage is the easy peasy lemon squeezy one. It is not requiring very much effort. It is who can make the most given the same. I am assuming they have been given an even playing field. The question will usually tell you, like they'll be like, hey, this is how much they can produce in a day or how much they can produce in an hour or whatever. Like that's the same resources, time. So who can produce more desks? Brandon, done. Absolute advantage, Brandon, desks, done. No work, no math. Didn't have to think about it, didn't have to write anything down. If you know what absolute advantage is, it takes you literally a second to figure it out. Absolute advantage for chairs. But it's the same. Means neither. Neither of them is better than the other there. They're evenly good at it. They're equally good at it. So there, that's not too bad either. Okay. Comparative is lower opportunity cost. What you have to do to find comparative, and it's why comparative is a hassle, is you have to figure out the opportunity costs. You have to be able to figure out for every one desk Tony or Brandon makes, how many chairs did they give up? Because if they can make them both in a day, they can't make 20 and 10. It's an either or deal. Tony could make 20 desks in a day if he just made desks. He can make 10 chairs in a day if he just made chairs. So for every desk he makes, he could have made, I was like, well, he's twice as good at desks, so a half. 1/2 of a chair. So the idea here is that, and the way I did this technically, like the shortcut, is other goes over. To find the opportunity cost, it's because this is a output problem where the numbers in the table represent the number of things being produced. So like number of desks and chairs being made, output. So I take the other column's number, 10, goes over my current column's number, 20. So I got, this is 1/2. It's fairly small for you guys to see. I apologize, but it's 1/2. So for every desk Tony makes, he could have made 1/2 of a chair. For every desk Brandon makes, he could have made 1/3 of a chair. And then for the chairs, it's 2 and 3 respectively. One sec, another email. One sec, this is kind of an important email. One moment. Okay. So the comparative advantage 2 has the lower opportunity cost. Brandon has a lower opportunity costs in desk because it costs him fewer chairs per desk. Tony has a lower opportunity cost in chairs because it costs him fewer desks per chair. The basic idea is it's whoever is giving up less to make the thing has the comparative advantage. Sorry, sub stuff for today. One second. Okay. Really hope that goes through. All right. So that's comparative advantage when it is an output problem. The other way you might see it is an input problem. This is where the typical confusion happens for kids where they like really get freaked out. Like, how do I tell if it's input or output? Read the question. That's how you tell. If the numbers you're given are numbers of things being made, output. In an output problem, I want the biggest number possible, right? Like I want whoever can make the most desks, I'm looking at the bigger number because that's who can make the most, right? Output, big number, good. Input problems, I'm just going to erase the opportunity costs, happen when the numbers in the table represent the resources used to make a thing. Now, where some of you guys get stuck is you like look at my table and you're like, but McRitchie, it says 20 desks and 10 chairs. Yeah, but if I write over here that the numbers in the table are the number of minutes to make one desk or chair, then that makes it different. Number of minutes to make one desk, one chair. It takes Tony 20 minutes to make a desk. It takes Brandon 30 minutes to make a desk. Who is better? Tony, right? Because if I gave them both an hour, conceivably, Tony could make 3 desks, Brandon would only make 2. So if they flip up what the numbers in the table are, then it's input. If the numbers in the table are the number of resources used to make a thing, usually this is like minutes or hours, time is very common for this, stuff like that. That's when it's an input problem. When it's an input problem, the things that change are absolute advantage, you're going to end up looking for the lower number, but the definition of absolute advantage is the same. Absolute advantage is just who can produce the most given the same amount of resources. Well, if this amount of minutes to make one of each of these, Tony could make more. So Tony has the absolute advantage. The definition saved me. For comparative advantage, it is whoever can produce it at a lower opportunity cost. That I still have to figure out. And that's the only part that people tend to get tricked up on, is that on an input problem, the way you find it isn't OGO, it's OGU. You take the other number and it goes under. So the opportunity cost of one desk is 10 under 20, or 2 chairs. But listen, the logic is going to still make sense, because if it takes Tony 20 minutes to make a desk and 10 minutes to make a chair, then every time he's making a desk, he could have made 2 chairs. So whenever he's making a desk, he did give up the opportunity to produce 2 chairs. So I do OGU to make that logic pan out. For Brandon, it'd be 3. But the definition of comparative advantage doesn't change. Neither of the definitions change when it's input or output. The definition of comparative advantage is who can produce it at a lower opportunity cost. Cool. 2 is lower than 3. My definitions of absolute comparative advantage don't change when it's input or output. It's just how I find the opportunity cost does change, and I just got to think about it a little different, but not really. Because I'm still thinking, who can make the most? Tony could make more desks because it only takes him 20 minutes to make 1 desk and 1 chair. So you've got to be very careful and mindful, frankly, of what it's saying there. Cool. Let's do Mona's question. Mona said, yeah, you can't comment. I don't know what's going on with the live stream, why you can't comment on it. It's probably some school computer Wi-Fi thing. That's why I wanted to do it at home. Whatever. Thank you, Barb. That's good to hear. Okay. Whew, I was scared. Okay. We're getting this other stuff sorted out, it looks like. Okay. Can you go over the difference between current and financial account and debit versus credit on those accounts? Okay. So the debit credit thing is less of a big deal, only because they don't ask that as much. Like, it's like a thing that matters when it comes to accounting, but and those are technically an accounting thing, so I explain it there, but maybe someone just asks that much. Debit versus credit is just if money is being earned by your economy, that's a credit. If money is being sent out of your economy, that's a debit. So like if there's a transaction like an American is buying a bunch of property in France, that transaction would be a debit for the United States because money is leaving the US's economy. So debit versus credit is just like capital flow, basically. Is money going in or out? Debit, out, credit, in. That's all that is. The current and the financial account, or the balance of payments, which if I'm wagering, I'm betting 1 question on this, on the multiple choice section, probably. It's enough of a topic to be a question. Maybe 2, maybe it's a end part of an FRQ, they just throw this in just for fun. But balance payments isn't like a massive topic, it's just a thing that they can throw in there for fun. Your balance payments accounts, there's 2 of them. There is the current account, and there is the financial or capital account, which might also be called a financial and capital account, which is fine, whatever, do whatever they need to. There's only one thing there. So these are just where you record all of your international transactions as a country, just like it's probably a blockchain now, I would bet, but it's probably just like, it used to be like just like a dossier, and a massive Excel spreadsheet, effectively, of where you would record all the international transactions, because you want to know if there's more money coming in or going out of your economy. That's like the general idea. How does interest rate affect every graph from Vivian? Yes, I can do that, Koya. That's up next. Okay. The current account has 3 big things in it. Net exports. Should always know what that is. That should never be a confusing thing for you. That should always be an easy thing for us. Where it's just, if it's an import or an export, current account. So if you're ever asked, is this put in which account or which of these is an example of a thing in the current account, look for imports and exports first. That's the easy thing. You've got net investment income, or net income from abroad is how it's written sometimes on the AP exam. Shouldn't have to worry too much about that, but if you're looking for example of it, it's like money usually earned in the form of interest overseas. So like having a savings account in another country and it accumulating you interest. The interest that is coming to you from another country is investment income. That doesn't show up super often If they ask you to calculate current account and they list this as a thing, add it, but don't sweat it outside of that. And net transfers, which is the direct sending of money from one location to another. The direct sending of cash from one country to another. That could be in the form of literal government aid, like if you're helping some country that's having a really rough go of it and you send them like $5 million just to help keep them afloat. That goes there. It could also be remittances, like people from another country sending money to their family. That's also a net transfer. The reason why they're all net is because it could be positive or negative for us. If money's coming into the United States, it's positive. If money's leaving the United States, it's negative. So like if I send my money overseas to a family member, that's a negative for the US because money's leaving. The capital account only has one thing: assets. It records the sale of assets between countries. This includes bonds and stocks and stuff like that. It's like financial assets. That's why it's called the financial account. It includes financial assets. It would also include things like real estate, like a physical asset, a thing I'm buying in another country where the game plan is that I'm going to be making a bunch of money off of that long term, probably not short term, like a long-term play, if you will. Oh, one sec, phone call. I mute myself. They're calling this room. That's wild. Okay, guys, I'm going to pause the stream here. Don't worry. I should be able to go back online in a bit. They need somebody to check on my kids real quick in first period because they don't have a sub right now. So I have to get down there and check on them, make sure everything's going okay. Worst case scenario is I can go back live at the start of second period, which is one of my econ periods. So worst case scenario, I can do that, which would be like 9:20-ish. So you might need like a 30-minute break here. Apologies, but the school is having a hard time finding subs today because of AP exams and everything like that. So I'm gonna go get that sorted and deal with this. I'm gonna pause the stream here, like end it for now. I'll go back live here in probably worst case 30 minutes or so and pick back up where we left off. But just to clarify for Mona, so I can finish that last bit. The big thing to note here is that these two accounts offset each other. If this one's positive, this one's negative, all you've really got to worry about is what things are tracked in each. And if one's positive, the other one's negative. That's kind of about it. Okay. Apologies for this, guys. School's having a hard time figuring out sub stuff today. So I've got to try and move around the school quite a bit. So BRB.